Iced Radio, take 1.
Dunkin' iced coffee is... Ooh, sorry, one more time? Dunkin' iced it... Ooh, Kelly, we're trying to record a timely summer-focused radio spot for Dunkin' Iced. Can you stop with the shaking?
But, this is the sound a Dunkin' Ice makes. Maybe you should keep it in?
Well, yeah. That's actually a pretty good idea. Try all the Dunkin' Refreshers, iced coffees, cold brews, and lattes. Dunkin' Iced. America runs on Dunkin'.
A good time starts with a great wardrobe. Next stop, JCPenney. Family get-togethers to fancy occasions, wedding season too. We do it all in style. Dresses, suiting, and plenty of color to play with. Get fixed up with brands like Liz Claiborne, Worthington, Stafford, and J. Farrar. Oh, and thereabouts for kids. Super cute and extra affordable. Check out the latest in-store, and we're never short on options at jcp.com. All dressed up, everywhere to go. JCPenney.
As long as they're financial. 888-99-CHART is our number, 888-992-4278.
Justin and Steve, Matt in South Florida. Love the show. Wanted to ask a question about current CD rates. Not something that, in the past 10 years we've talked about much, but currently you can get, for example, at Sallie Mae, about a 2.5-year, roughly a 27-month CD at 5%. So I guess my question for you guys is, can you make a case at this point for why locking up for the next 27 months at 5% is not a good idea? I know that most experts have told investors to lower expectations for what the market will produce from instead of 8 or 9% to something like 6% for this decade in the 20s. So with that being the case, and with the next year being very uncertain, or maybe 2 years being very uncertain, is there a case to be made to not put a significant part of investable funds into a 5% 27-month CD? Love to hear your take on it, and I'll listen for your response on the podcast. Thank you.
Well, as I think about it, I don't really have a problem with 5% for 22 months or so on a CD. You are going to, inflation's running at 6, so you're going to lose buying power. You're losing 1%. You can buy dividend-paying stocks that pay higher than 5%. That are some of them pretty conservative, so I do like that. But a CD is really conservative, and there's no risk to the principal at all. So I don't have a problem with a portion of your portfolio being put into a 5% CD. I really don't. If you're conservative and that's what you want, the market will probably outperform that in the next 22 months, in my personal opinion, but not the beginning of this year. 2024 looks a lot healthier for the market, in my opinion. So I'm not sure, I would put my money away for that long of a time. I think I'd rather put it into treasuries. Personally speaking, they're much more liquid, and I can sell them if I wanted to. Anyways, but no, I don't think it's a bad idea. I don't think it's a bad idea at all. Okay.
Hey, Steve and Justin, it's Brian and Ruby up in Marin. Thanks for all that you do. Wanted to get your thoughts on how to play the current weakness in natural gas. Thanks.
I would be a buyer. I think natural gas is here to stay. It's a fairly clean energy. It's not perfectly clean, but it's a lot cleaner than oil. And it's abundant here in the United States, and prices have been elevated. I think it's come down a little bit, but I think it's going to be still in huge demand going forward. I do. And we're building LNG, liquefied natural gas facilities in the Gulf states, and Europe is going to need our LNG. So they're going to need our natural gas. So I think it's got a good future ahead. I do. So I like natural gas. I think I take advantage of any weakness. I go buy some natural gas plays. That's what I would do.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Good morning, guys. Thank you for your show. I just have a question. Now that the rates are high for a traditional consumer time account, what would be the difference if I were to set up a brokerage CD versus a traditional CD? Meaning, what would be the risk with the brokerage CD since there's no risk with the traditional CD? Thank you. I appreciate your answer. Thank you. Bye-bye.
Difference, a whole lot of difference. They're still certificates of deposit. They're still backed by the FDIC, but you get more selection. Basically, you're buying these through your broker, whether that's Fidelity or Schwab or TD Ameritrade, whatever. And oftentimes the rates are higher. You can sell them if you want to get your money out. So they're kind of like holding a bond. Okay. And those are the main differences. I don't think you should be favoring one over the other, really. It's more about what is that yield? What is that maturity? You can get a lot of longer maturity CDs in the brokered space. So I have no problem with them. And I kind of like that you can sell them in the secondary market if you need to get rid of them. You know, if interest rates drop, you've locked in a longer term CD, you can probably sell them at a premium, right? So if you can find better yields and the right maturity date for you, brokered CDs are just fine.
You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward? I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk here.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Foods, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hello, Justin and Steve. Raphael from Jersey. Been listening to the show for years. Love it. It's one of my absolute favorites, and I told dozens of people about it. Justin and Steve, I have a very serious question. It's my biggest concern, and it's about the U.S. dollar. My concern is that this second economic bloc that seems to be forming with the sole purpose of getting off the dollar, wouldn't that happening be dramatic impact for everybody that has U.S. dollar assets? I mean, wouldn't this be a cataclysmic event to have that happen? Because I'm pretty worried about it. I'd like you guys' opinion. Thank you. Bye.
Well, the demand for dollars is broad-based and well-diversified. And that's what most people miss when they're looking at the dollar's reserve currency status. Now, the first thing I always say is, what's the alternative? There really isn't, if you're talking about a fiat currency. Whether that's Chinese yuan, the euro, whatever it is, no country has the rule of law, the military, the global reach to usurp the dollar. So I don't think it's anything that another country can offer. And on top of that, you have a global financial system that has a lot of dollar-denominated debt. And how do you pay back that debt? Well, you pay it back with dollars. And what do you need? You need to pay those debts, right? If you have a mortgage, you can't show up to the bank and give them euros or yuan or Swiss francs. You have to give them dollars. So if you get paid in some other currency, or you have a job overseas, whatever, you have to move that currency into dollars, exchange it. And so entities around the world have to do that. These aren't individuals, but they're corporations, countries. And so it creates this natural demand for dollars. And so many commodities are priced in dollars, not just dollars. Or sorry, not just oil. Everyone talks about the petro system. That's certainly a big part of it. But a lot of commodities are priced in dollars. And so when people try to say that there's this cataclysmic event, as you said, I just don't see that in the near term. Anytime soon. Now, eventually, could that happen? Sure. Never say never. There's going to be a shift in the global financial system at some point. But it may not be in our lifetime. It needs to come from something that's, a little more substance than Bitcoin, for example. So I understand your worry, but you have to understand the diversity of our global financial system.
The InvestTalk voice bank never closes.
I have a question for you about Amazon.
So your questions keep coming.
Question about PE ratios.
And that's okay, because Steve Peasley and Justin Klein specialize in unbiased guidance.
If I'm looking at a dividend company, I'm looking for consistency of earnings and dividends.
Your standard daily chart typically goes back 1 year.
Steve and Justin are fearless, so don't forget to call InvestTalk. 888-99-CHART.
Now, when people take the time to leave an InvestTalk podcast review on iTunes, I'd like to thank them for their courtesy by getting to their questions quickly. Zero Cool 208 says, I have a 401k with a employer match. Recently, I had a child and started a 529 plan and consistently investing in my own E-Trade. Question 1, should I even bother investing extra income myself or have my current 401k account holder do it for me? Easy. Invest up into your company match. Okay, up into your company match. Then beyond that, if you want to save more for retirement, IRA, if you are eligible. Ideally a Roth IRA if you're eligible for that, if you don't have super high income. And then if you can contribute to an IRA and take the write-off, I would do that as well. Make a lot of money, maybe doing a backdoor Roth, that's a good idea. But you shouldn't invest more in your 401k past the company match until you've maxed out your IRA contributions. Then you can go back. If you have more than that, then you can go back and put it in your 401k, because you're outside of the 401k, you're going to have a lot more investment options, right? Your Vanguard 401k is going to be very limited in options, probably just index funds. So not the greatest choices. So you want to get as much as you can outside of it, but you're never going to beat the company match. So you want to make sure you get that. Now, question 2 is it wise to double down on a stock when it's falling in a bear market? For example, I own Apple stock, but when it started trickling down to mid-130s, I doubled down, making my average price per share go down. As I sit now, I'm faring well. Would you recommend this strategy for select known companies that most likely will do well over the course of the long term? Well, the general rule is that when you're down, it means you're wrong, right? You bought the stock and you bought it too high because it went down. Now, everybody's wrong, even professionals, so that can be fine. But oftentimes, especially names that aren't as strong, from a business perspective, you were probably wrong, right? Their business may be up and down, and you picked the wrong time to get in. And so throwing good money after bad is usually a bad idea. But going back to first principles is owning good companies, allocating to good companies with good business models at reasonable prices. That's really what you should be focusing on in general. And Apple is obviously one of those names. great business, great company. It's going to ebb and flow between being over and undervalued. But over the long term, as long as their stranglehold on the smartphone market is maintained, they're going to do fairly well. So it really comes down to the actual company you're talking about. And in Apple's case, averaging down, probably a good thing.
You're listening to InvestTalk, everybody. I'm Steve Peasley. We want to answer your questions. Our listener line number is always ready for you, 888-99-CHART. Beginning our experience, we're here to answer your question.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hi, Steve or Justin. This is Craig in the mountains outside Seattle. Got a diversification question, but it's within an asset class. So I use the strategy pretty much across my brokerage account. So just as an example, if I wanted 20% of my portfolio or of my brokerage account to be small cap value, and I've got IJS and AVUV, similar expense ratio, good performing funds, respectively, there's a 26% overlap in holdings from the IJS side and a 40% from the AVUV, which feels like it gives me a lot more diversification in that small cap value realm. But the question is, am I overcomplicating it? Is the diversification worth it? Or would you just pick your favorite one and have that represent the whole asset class? I'm in the same situation with large cap value and my internationals and, a couple other things. And that's just a strategy I've employed where there's a relatively low overlap, but more diversification. Just curious your thoughts. I tend to lean value, very aggressive. Portfolio is worth about $1 million at this point. And so it's a relatively small part of it, but I'm far heavier in large and small cap value, both U.S. and international, than anything else. Wondering your thoughts on that strategy and if I'm just overcomplicating it or if it makes sense. Thanks so much. Love the show. Look forward to hearing from you on the podcast. Thanks.
Thanks for the call. Now looking at two small cap value ETFs, and I have no problem with that. Both of these ETFs, AVUV and the IJS, they are small cap value, but both of them are good funds. Both 4 out of 5 stars at Morningstar, both bronze rated. So they're good funds, and because they're small cap value, right, they're going to have some overlap there. And it's not clear which one is truly the better one to hold long term. So you're kind of hedging your bets here. You're saying, okay, I'm not going to try to pick kind of the main focus point, which is I'm not going to focus on picking the perfect one, but I want to have this percentage allocation to small cap value, and so I'm going to spread it among 2 or maybe 3 different choices that I think are all very good, and not put all my eggs in that one basket of this fund is probably a little bit better, so I'm just going to put all in that particular fund. I don't mind having that, and you're going to have, like you said, some overlap there, and there's nothing wrong with that. So, there's a lot of options out there, from individual stocks to mutual funds and ETFs. There's just a lot of options, and despite what many will say, there's a lot of good active options, right? That allocate capital well long term, especially these smaller cap funds. And so when you have multiple good options, spreading it amongst multiple good options means you'll probably come out not perfect, but in good shape. And as our main focus point today said, that's the main goal.
This is InvestTalk, made possible by KPP Financial, where they describe their services as independent thinking, shared success. And this philosophy is why KPP Financial can be of great value to investors. KPP principals Steve Peasley and Justin Klein are committed to unbiased guidance. They don't upsell clients into expensive and questionable investments. Instead, Steve and Justin provide honest opinions and proven strategies. based on the individual's current portfolio and risk tolerance. Working with KPP Financial, you can be assured of consistent dedication toward the goal of helping you achieve financial freedom. You can get things started with a phone call or a simple message through InvestTalk.com. The InvestTalk radio and podcast continues now. The phone lines are open. Call with your questions. 888-99-CHART.
Hey, Justin and Steve. Nick from New York. Love your show. Just I guess kind of a financial question for you. I recently purchased a car. Love the car. Unfortunately, very high interest rate, 8.4%. Probably owe about $36,000 on the car. Sitting on about maybe $75,000. Kind of wanted to use that money in the next year and a half to buy a piece of property with my father. Well, I'm not sure if it's going to be a vacation home or an investment property, but, it's kind of our dream to do it together. My question to you is would it better serve me to pay off my car loan first at 8% interest? I'm kind of thinking that it probably would be. Or do you think that I kind of keep my cash freed up so that I would be able to make that purchase? Thanks for your help, and looking forward to your answer on the show. Thanks.
I would easily pay off the car. 8%, you're basically guaranteeing yourself that yield on that money over that time period. And you can free up whatever that car payment would be and try to save and continue to save to buy a property with your father. And, we're in probably year 2 of 3, 4, 5 year correction in property prices more generally. And so you can be patient. It's not like you're missing out on the market really running away from you to the upside. It's a market that will kind of have its fits and starts. You saw that last year where really activity declined dramatically throughout the summer, perked up a little bit late last year and into the beginning of this year. Now it's kind of rolling over again because interest rates are back up. So I don't think you need to be in a quick hurry to buy a property, and I wouldn't sit there and wait and pay 8% while you're waiting. I wouldn't pay 8% on that car loan. So yeah, it would make sense for you to really pay that off.
Now is a good time to call InvestTalk.
A warrant is a right to buy shares of stocks at a certain price.
What's your question?
Would you recommend to put all my funds right away in the market, or you recommend dollar cost average?
Got a question for Steve or Justin? 888-99-CHART.
So, how does it feel when you play Roll Up to Win with Tim Hortons? Buy a hot or cold beverage using the Tim's app and find out. Roll in the app for a chance to win prizes ranging from free coffee and donuts to a Universal Orlando resort vacation or a sweet car. Oh, don't forget the TV. And this year, every roll is a shot at a $1,000 daily giveaway drawing for 2 $500 prizes. Roll up to win and get treated by Tim's. No purchase necessary. Account registration required. 50 U.S. and D.C. 18 plus entered by 4/2/23. See rules at rolluptowin.com for free entry or full details. Void in Florida and where prohibited.
A good time starts with a great wardrobe. Next stop, JCPenney. Family get-togethers to fancy occasions, wedding season too. We do it all in style. Dresses, suiting, and plenty of color to play with. Get fixed up with brands like Liz Claiborne, Worthington, Stafford, and J. Farrar. Oh, and thereabouts for kids. Super cute and extra affordable. Check out the latest in-store, and we're never short on options at jcp.com. All dressed up, everywhere to go. JCPenney.
You will fail. So what? Everybody does. It's time to redefine success. Meet BODY. Fun workouts and a week off. Healthy eating and indulgence. Liking yourself no matter what. Yeah, you will fail. We all will. But we're not going to let that be the end. You see that? We're already making progress. So let's keep going. We are BODY. Start your free trial at BODY.com. That's BODI.com.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Hello, I'm a 58-year-old, and I have a question. I probably won't be retiring until the age of 65, maybe 67. And in my employer, I have an option for 401k and a 401k Roth. At what point do I kind of migrate all my contributions over to the 401k Roth versus getting the pre-tax dollars? it would seem to make sense that Roth might be a better choice. Thank you. Bye.
Well, the way to always think about Roth versus IRA or traditional IRA, or in this case, Roth 401k versus traditional 401k, is always your tax rate today versus what you expect it to be in the future. So this is why typically younger people should invest in a Roth IRA or a Roth 401k, because they are not getting a great tax write-off. They're not in a high tax bracket. So whatever they put in isn't a great benefit to them today anyway. Now, others who might be in a relatively high tax bracket, they might want that tax write-off, and they will take the money out in the future when they're no longer working, when they're retired, and now they're in a lower tax bracket, and locking in that lower tax rate when they do take the money out of the traditional IRA. So it's all about the tax rate that you're at today versus what is expected in the future. And that's how you think about it. It's pretty simple, but it's also not an easy answer for everybody, especially those that are in a middling tax bracket. I always say if you're on the fence and you're able to put money into a Roth IRA, because remember, there are Roth contribution limits. At some point, so you can't income, you can't put money into a Roth IRA. And so if you're eligible and it's kind of on the fence, you're in a middling tax bracket, maybe a 22, 24% tax bracket, I go Roth IRA or Roth 401k. Just because you're able to get total amount more, tax deferred. You never have to pay taxes on it again. It becomes a nice savings account for you. If you ever want to take money out, especially a Roth IRA, remember you can always take out the contributions to a Roth IRA without any penalty, not the growth, but the contributions. So that's always nice. So that's the way to think about Roth versus traditional IRA or 401k.
Hi, this is Randy from snowy Minnesota. Wondering with like a brokerage firm of TD Ameritrade or Schwab or any of those, and they say there's no fees to buy and sell stocks. How do they make their money? I'll hang up and listen. Thank you.
That's a good question. First off, cash. They do make a lot of money on the cash that you're holding. There are fees to wire funds and things like that they'll charge. But a lot of it is, there is a good amount that has to do with the trading. That's why you probably don't want to use market orders. You probably want to use limit orders. That is going to help limit your costs there that are kind of unseen. I know the SEC is trying to instill a little bit more transparency in how these companies make money. And for small traders, it's kind of worth it, better than paying $5, $7, $10 in commissions. But understand that they are making or selling their order flow to companies like Citadel, and there's some issues with that I think the SEC is going to clear up over time. It'll impact probably their business. But they do make money in other ways. Like I said, they take their cash, they invest it, they may pay you a lower rate than what they're getting on that cash, et cetera. So that's a big reason why. That's a big way that they make money. Right? Thanks for the call.
This is InvestTalk, made possible by KPP Financial, where principals and InvestTalk hosts Steve Peasley and Justin Klein are independent financial advisors. For clients, they are fiduciaries. Steve and Justin have a duty and a commitment to always place the interests of their clients ahead of the firm. This is different from the way many other organizations operate. And one way you can realize the benefit of an association with KPP Financial is to know that KPP practices parallel investing. This means that the personal investment accounts of KPP principals participate with client investments at equal prices and percentages. It's an important difference. You can learn more anytime at investtalk.com. Or reach out to Steve Peasley and Justin Klein by emailing or calling their Irvine, California office. The InvestTalk radio and podcast continues now. The phone lines are open. Call with questions, 888-99-CHART.
Hello, Steve and Justin. This is Paul from Germany
Congratulations to your 50 million subscribers. First of all, I'm very happy for you guys, and I'm very thankful, and I appreciate the work you guys do. So my question today is about corporate bonds. I would like to apply this question on Microsoft specifically. The stock makes around 6% of my portfolio, and it pays a dividend of a little over 8%, and it's up like 50% since I bought it. So the question is, like, would it make sense to take some profits and reinvest it in the bond of the same company? I saw one expiring in March 6th in 2027, yielding 3.3%. My question is basically, how does it work? Do I get the annualized yield plus my invested capital back, or does that depend on the share price at the moment I sell? My assumption is that tech stocks won't overperform the coming years, considering the midterm market environment, and that's why I'm looking for a way to maximize my cash flow. And I hope my question is not too complicated and can be answered on the podcast. I'll be looking forward to hearing the answer, and thank you guys for all your help, and congrats once again also for the community you guys built. This is the number one platform for me when it comes to investing. Thank you. Bye-bye.
I appreciate those kind of words. And you're looking at Microsoft. You're up pretty decently, it looks like. I wasn't quite clear on how you're calculating this, but I think the main question is, should you sell out some of your Microsoft stock? Is the bonds a better buy right now? Well, you're looking at the 2027 bonds yielding about 4.6%. Not great. I think there's better opportunities in the corporate bond market than that. You can get a 6-month Treasury and get 5%, right? So I don't love that. I don't love that alternative. I would say I do think it's a time to reduce your position in Microsoft. I'm kind of somewhat down, as I am on a lot of the large cap tech space, especially the tech software companies that are tied to businesses who are laying off a lot of tech workers that use Microsoft products, for example. So I would be trying to lighten your load and your exposure to Microsoft, but I wouldn't necessarily just go to the bonds. And what you're going to look at is not just the coupon rate, because the coupon rate can be very different between different bonds that you're looking at, even different bond issues of the same company, right? Where Microsoft, that one you're talking about, is a coupon rate of 3.3%. But if you look at something like the ones that mature in August of this year, the coupon's 2%, and that yield to maturity is about 6.5%. So very different there. So you're going to look at total yield. Yield to worst is what you're going to want to look at in the corporate bond space. Let's go to Dan in Concord. Wants to talk about gold stocks.
Hi, Justin. Thanks for taking my call. Hey, I was calling about both gold and oil. I've got a couple positions in each, and I was wondering if this is a good time to add on.
Yeah, we actually added on some of the gold names in our portfolios today in a nice bullish day off some major support. So we like that space overall. We don't think rates are really going to break out. You had rates come in a little bit today and reverse really from the highs. So that's always a tailwind for gold prices. The dollar was strong, but the gold was actually up on the day. So that was a nice little change of scenery after this recent pullback. Overall, the technicals on the miners remain fine. Obviously, a strong pullback over the past past month or so, but nothing has changed that uptrend. That remains since the lows back in September. So we still like those. The energy space, that's been a bit more volatile, and but overall an uptrend. So I think I'm fine with both. I'd be buying them on dips.
Great. Thanks very much for your help.
No problem.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Yes, this is Kevin White from the Bay Area. I had a question for Justin. I wanted you to weigh in on S blocks, securities-backed lines of credit, and I wanted to know if there were any strategies for or any benefits in using S blocks before you die.
I've never thought about that. It's a bit morbid, but I'm sure you still have to pay the money back, right? Because these are securities-based lines of credit where you're taking your investment portfolio and borrowing against it. You're basically taking out a margin loan, and instead of buying more stock, you go buy something else. You go live your life. You go buy a piece of property, whatever. The issue, though, is if there's volatility in your portfolio, you could get margin called, just like you can in your normal portfolio, right? You can be forced to sell those positions at a bad time when the market's down, for example. But this is something that is kind of a corollary to buy, borrow, die, right? Where instead of selling your positions, and this may be what you're talking about, and a lot of the uber wealthy do this. Elon does this all the time, where instead of selling his Tesla stock, although he did a lot last year to finance his Twitter acquisition, etc., he would just borrow against it, because when you sell the stock, you are triggering a capital gains, especially if you founded it, the company, or you were an early investor, like Elon was in Tesla. Your cost base is very low, and you go sell it, that triggers a huge capital gains tax. But instead, you borrow against it, pay a low percentage, 3-4%, and you go and use that money for whatever you want. And you aren't triggering that capital gains. And then when you die, you have that stepped up basis where your heirs get the value when you die, right? Or the cost basis when you die. So that's kind of the buy, borrow, die, or found a company and borrow against the stock and then eventually die and pass that on to your kids or your next of kin. So that maybe is what you're talking about. It's usually for the uber wealthy, where you have millions and millions of dollars to borrow against. But interesting. But there are risks with it, and you are paying interest. If you're not paying the government, you are paying interest.
Hi there, guys. Hey, I had a question about what Justin was talking about yesterday about the stock buybacks. Do companies can they own their own shares of stock? And then, because I was under the impression that stock buybacks were like removing the total number of shares out there, which made each share more valuable. So I just wondered if I could get clarification on that, but really appreciate the program. Thanks, guys. Bye-bye.
The answer is yes. You can. The companies, that's what stock buybacks are. They buy their own shares in the open market. And when you're reporting things like earnings per share, the number of shares that you're dividing the earnings by goes down, and that actually looks at least the perception of earnings growth. And sometimes that's a good use of capital for companies, and companies do that consistently over time. Others also do that at bad times. When times are good and the stock's really expensive, we see that happen a lot. So it's really, timing is certainly important and what value they're paying for it. But they can buy back their shares whenever they want. It's the opposite of issuing shares, right? When company issues more shares, it's diluting shareholders. And it's making each share less valuable because there's more shares outstanding. And the vice versa. When you buy back shares, it makes each individual share a little bit more valuable because it's one of a smaller amount. So it makes them less or more rare. So that's how stock buybacks particularly work. Thanks for the call.
Hi, Duncan from New York. First off, I would like to thank the caller from last week who asked about brokerage CDs. I was actually able to find one on Fidelity that was offering a 4.65 yield compared to my savings rate on Capital One, which was only 3.5%. So thank you, InvestTalk, for having or allowing us to figure out these answers. So anyways, with that being said, I am currently in a situation where I'm starting to shift my capital towards fixed income, savings account, and very less risky assets. I actually moved some money to the Fidelity-Backed that gets a higher yield. So thank you, InvestTalk, for letting me look into that as well. I am about to pay off a condo in July, and I actually have some stocks I would like to sell and kind of give me more cash for my down payment. But my two-part question is, one, I have stocks in all sectors right now to obviously diversify. Which sectors in the next 3 months should I consider to trim besides tech? And I appreciate all of your guidance. Have a great day. Bye.
Well, if you just go to what we discussed before, the sectors that are going to struggle in an inflationary environment that tend to be more like bond proxies, that's where you want to trim first. And that would be the defensive sectors, right? Your consumer staples, consumer defensives, as well as healthcare and utilities. So those are the first three right off the bat. And then probably from there, consumer cyclicals, that's one where if the economy continues to slow, those companies are going to continue to struggle. So I think those are good places to think about trimming. Thanks for the call.
Now, if you have a question about a stock or an IRA, college savings plan, well, maybe buying a house, mortgages, reverse mortgages, we're here for you. 888-99-CHART, 888-992-4278.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Let's grab another caller question now at 888-99-CHART.
Hi, Steve and Justin. I have a question regarding T-bills. I was looking at the 26-week T-bill that is earning almost 5%, and was looking to put that in to my retirement account. And one option they offer is if I want to reinvest, but I plan to use the interest later on that it earns for income. I'm not in a high bracket, so just wondering, how do you know if it would be good to reinvest or just wait till it matures and invest in another term? I'll be listening to the answer on your show. Thank you.
Well, I definitely wouldn't reinvest and make that decision today. Right? You can go buy it and you get your money after the 6 months and you go reinvest it if you want to, or you go do something else with it. So there's no real upside. You're not losing out on anything to reinvest, because they're going to reinvest it at whatever rate is at that time. So, it could shift. You can see the 6-month T-bill in 6 months at 3%, right? If the Fed starts an easing cycle, for example, by the fourth quarter. So they are fairly attractive at that 5% rate. No credit risk. But no, after 6 months, that could change. So there's no reason to sit there and reinvest the capital when you don't know what rate you're going to get in 6 months. Thanks for the call.
Hi, I had a 401k from a previous employer that was automatically rolled over into an IRA. It's just in cash currently. And I'd like to move that over to a Schwab or a TD Ameritrade or something and just get a little experience day trading with that money, if possible. I've been playing with a little of my personal money in Robinhood accounts. I don't play with my 401k at all. Don't touch that at all. I max out the contribution. Is it possible to day trade with money that was formerly in a 401k? And am I going about this the right way to get experience? I'd love to hear your answer on the show. Thank you.
Well, there are sometimes rules around day trading in an IRA, especially if they're under $25,000. So typically look into that with what the broker's rules are on it. I definitely would move your money away from Robinhood. I don't think anybody should have their money in Robinhood anymore, especially with Schwab, TD, E-Trade, Fidelity, all having commission-free trading. So I would try to consolidate your IRA and brokerage account into one firm. We use TD Ameritrade, but they're all pretty good. Just definitely make sure they're all SIPC insured and big. So definitely go with that route. Now, day trading, 99 out of 100 people who day trade fail. So your odds of failure are very, very high. If you're going to day trade, start with paper trading. Start making real live decisions. Don't look backwards and say, well, what if I did this? Say, okay, I'm going to to say, I'm going to pull the trigger right now. If I did that, my fill would probably be this. Put that down in a spreadsheet and then start paper trading. Okay, I would get out here. Put that down. And be honest with yourself as well. Be very, very honest with yourself. And there are actually even paper trading programs out there that you can use. So paper trade first. Find a strategy that you find works week after week, and frankly, month after month. I would paper trade for 6 months before you do any type of day trading.
Hi, Steve or Justin. This is Josh from California. How are you guys doing today? I have a quick question involving options. I've been paper trading on my TD Ameritrade account, options just to get a feel of it. But one thing they keep reminding me is risk of dividends. What would that mean for a long call for me? Do I owe money? Or is that reduced from the value? Just curious. Thank you. Have a good one. Look forward to the answers. Bye.
Well, what dividends can do is they can trigger, it's a potential triggering event, right? Triggering the option before it's actually expired, right? So, for example, I'll give you an example in the strategy that we deploy for clients, the covered call strategy. And every one of the positions in there pays some sort of a dividend.